Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Welcome to the deep dive. Today, we're diving into the wisdom of, well, one of the true greats in investing history, Peter Lynch. We've looked at a bunch of sources to pull out his core, timeless ideas, the principles you can actually use right now. If you've ever felt lost in all the market noise or just confused about starting out this deep dive, it's your shortcut to a common sense playbook that honestly works anytime.
Absolutely. And focusing on those fundamentals is maybe more important now than ever. There's just so much noise, isn't there? Hot tips, alerts, pinging all the time. It feels designed to overwhelm you. But Lynch's genius was showing that your best tool isn't some fancy terminal. It's your own brain, what you see every day. This isn't just for Wall Street pros. It's knowledge for you.
And his track record is just spectacular. He was vice chairman at Fidelity Investments, sure, but the legend really comes from managing the Fidelity Magellan Fund.
Right. He ran that from 77 until he retired in 1990.
13 years.
And what years they were. The Magellan Fund averaged, get this, a 29.2% annual return.
Wow.
To put that in perspective, that's more than double the S&P 500's return over the same period. He didn't just beat the market. He crushed it.
He really did. The fund grew from, what, $18 million?
Yeah, just $18 million all the way up to $14 billion under his management.
Incredible. And the really surprising part, he retired at 46.
Right at the peak. Peak performance, peak popularity.
Said he wanted to spend more time with his family. Apparently, his own father passed away at that same age, which influenced him.
Yeah, quite a story, a real lesson there, even though, he kept mentoring young analysts at Fidelity afterwards.
Okay, let's dig into his main philosophy.
Yeah.
The foundation for everything else. Lynch's most important rule. Sounds simple, but it's profound. Know what you own.
It really is the core. And it's your shield against fear.
Yeah.
Think about it practically. If you buy a stock just because someone mentioned it, maybe online or whatever, exactly, a hot tip, and then it drops, say, from $10 down to $8 pretty fast. If you have no idea what the company actually does, who buys their stuff, if they're drowning in debt, what happens?
You panic.
You panic. Fear just takes over and you sell. Probably at the worst time. We see data all the time showing really smart people throwing, serious money like $10,000 at something they heard on a bus, basically. Zero understanding.
That sounds more like gambling than investing, which I guess is why he disliked the phrase play the market.
Absolutely. He thought that phrase was dangerous. Investing isn't a game. It's buying a piece of a real business. A functioning company. You wouldn't buy part of a local bakery without knowing if they make good bread, right?
Right.
Treat the market like a casino, you'll get casino results. Long term, that usually means losing.
Okay, so rule 1, know what you own. How do you apply that? He talked about writing a script for each stock.
Yeah, like a story, or maybe a thesis is a better word. For every single stock you buy.
What needs to go in that script? More than just, I think this will go up.
Oh, much more. You need to get specific. Answer 2 key questions. Why will this specific stock succeed? And maybe, why is it undervalued right now?
Yeah.
But you can't stop there. You got to dig deeper. What's their competitive advantage? Their moat. What stops others from eating their lunch? What's their debt look like? What new products are coming?
And you write this down.
Write it down before you invest. Then, crucially, check back regularly. Does the story still hold up? Is the company delivering on what you expected?
It feels like there's less excuse not to do this today, right? Information is everywhere compared to when he started.
No excuse at all. Back then, you had to wait for annual reports in the mail. Now, company websites, quarterly results, investor presentations, it's all just clicks away. If you're willing to spend 5 minutes clicking buy, but not, say, an hour reading their latest report, well, you're setting yourself up for problems. That script forces the homework.
Let's shift gears a bit. Lynch talked about the individual investor actually having an advantage, an edge over the professional sometimes. How does that work?
It's about using what you already know. Your job, your hobbies, your everyday life gives you this sort of home field advantage. Like if you work in, say, the steel industry, you'll probably hear about new processes or big orders or maybe even problems way before some analyst stuck in an office covering 50 different companies.
Or even just as a consumer, right?
Exactly. Maybe you notice a new restaurant chain is always packed, or a certain brand is flying off the shelves at Target. That's real-world data, weeks, maybe months, before it shows up in the official numbers. You have to recognize that insight and maybe, just maybe, act on it.
Okay, but even with great companies, the market goes wild sometimes. Volatility. We have to accept that, right? Data shows the average stock on the NYSE can swing 100% from its low to its high within a single year.
100%. That means, yeah, at some point during the year, your stock could be worth half what it was at its peak, or double what it was at its low. Losses, setbacks, surprises, they are absolutely part of the deal when you own stocks. If you can't stomach the idea that your investment might drop significantly, even if the company itself is doing fine, then honestly, the stock market isn't the right place for that money.
So if big swings are guaranteed, trying to guess when they'll happen, that seems like where people get into trouble. Market timing. Lynch was really against that, wasn't he?
Fiercely against it. He basically said, look, far more money has been lost by investors trying to predict corrections or trying to prepare for them than has been lost in the corrections themselves.
How does that happen?
Well, people get scared, they sell everything, they wait for the bottom. But guessing the bottom is, basically impossible. So they sit on the sidelines and they miss the first big leg up of the recovery. That initial 10%, 20% bounce. That's often where the easiest gains are. And they miss it completely because they were trying to be clever. You got to be in it to win it, essentially.
He had that famous 13-minute rule, too, about economic forecasts.
Right. He said if you spend more than 13 minutes analyzing economic and market predictions, you've wasted 10 minutes.
Which sounds almost impossible today. Everything is about the next prediction, the next crisis. How did he tune that out? What should we focus on instead?
Just radical common sense, really. Ignore the gurus predicting doom or boom. Focus on what you can actually measure now. What are current debt levels like? Savings rates? What are the actual employment numbers? What are used car prices doing? Tangible stuff that tells you about the health of the companies you own and the consumers buying their products. Not some forecast about what the Fed might do 6 months from now.
And this ties right back to risk and your timeline, doesn't it?
Perfectly. If you need that money soon, say, for college tuition starting in 2 years, it absolutely should not be in the stock market, where it could face that 100% swing.
Needs to be somewhere safe.
Exactly. Money market fund, high-yield savings, something boring but stable. Match the investment risk to when you actually need the cash.
Okay, moving into strategy. Lynch loved the idea of hard work, of looking everywhere for ideas. He had that analogy about turning over stones.
The person who turns over the most stones wins the game. Yeah. It's just probability, isn't it? Investing success, finding those big winners, it's partly a numbers game. You have to look at lots of companies, turn over lots of stones to up your chances of finding one that's overlooked or undervalued. He was famous for looking for 10-bagger stocks that could go up 10 times. You don't usually find those just by looking at the biggest, most obvious companies everyone already knows about. You have to hunt in less obvious places.
But finding a winner isn't enough. You have to hold on to it. And that seems to go against human nature, which leads to his other famous warning. The one about gardening.
Ah, yes. Selling your winners and holding your losers is like cutting the flowers and watering the weeds.
Why do we do that? It sounds so illogical when you say it like that.
It's pure psychology. Think about it. A stock you own is up 50%. It's a beautiful flower. What's the urge?
Lock in the profit.
Yeah.
Sell it before it goes down.
Right. Fear of losing that paper game. So you cut the flower. Now, what about the stock that's down 50%? The ugly weed in your portfolio?
Hold on. Hope it comes back. Selling it makes the loss feel real.
Exactly. You stubbornly water the weed, pouring emotional energy, maybe even more money, into a failing investment. While you cut off your best performers just as they might be entering their strongest growth phase, it's probably the single biggest mistake investors make. You have to learn to let your winners run, way past your comfort zone sometimes.
That makes so much sense. Okay, so instead of chasing the hot stocks, Lynch liked looking for overlooked ones. Maybe companies that were out of favor or even having problems.
Yeah, especially if the problems look temporary and fixable. This is where that homework, that script, really pays off. You're looking for turnarounds. A great example he gave was focusing on companies where losses are shrinking fast. Like maybe a company lost $6 a share last year, but this year they only lost $2 a share.
Still losing money, though.
Still losing money, technically. But that improvement, that trend from losing $6 to losing only $2, that's a huge positive signal. It shows things are getting better, maybe rapidly. But a lot of investors miss it because they just see the red number, the loss, and they run away. They don't see the trajectory.
And we shouldn't assume that just because a company is already big and successful, its growth days are over.
Definitely not. Think about companies like McDonald's or Walmart. They were huge domestic successes, right? But then they went international.
And found decades more growth.
Decades. Massive growth. So when you're analyzing a company, you have to think about the total potential market, not just the market you see right now. The runway for growth can be much, much longer than you might think initially.
Okay, let's bring it to today. We've got AI, instant trading apps, so much tech. Does Lynch's basic philosophy still hold up in this modern market?
He firmly believed it does. He maintained that regular investors, ordinary people, can still get great results if they do the work, if they're careful, and if they really take the time to understand the companies they own. That core principle doesn't change. Interestingly, though, on tech itself, our sources say he personally holds no AI stocks. Describes himself as maybe the lowest tech guy ever.
That is interesting. So what does he think will be the big disruption from tech?
His focus seems to be more on automation than AI itself, at least in the near term. He specifically pointed to automating jobs like, say, truck driving.
It's a lot of jobs.
Huge numbers. He estimated something like 500,000 jobs could eventually be affected just in trucking. But characteristically, he saw the potential upside too: improved safety, lower costs for moving goods, which helps consumers.
But looking back, technology hasn't stopped job growth overall, has it? The long-term trend is still up.
Absolutely. The data's clear on that. Over the last 50 years or so, U.S. jobs grew from around 100 million to over 150 million.
Wow.
And the analysis suggests pretty much all of that net growth came from small businesses. New companies, entrepreneurs, firms with fewer than, say, 100 or 200 employees. It's not the established giants creating most of the new jobs. It's the smaller, innovative players.
One last thing before we wrap up. There's always this underlying anxiety, especially after big downturns, about another Great Depression, a total collapse.
Right. Lynch addressed that. He viewed a repeat of the 1930s as highly unlikely. His reasoning: the system today has multiple buffers, safety nets, that just didn't exist back then.
What kind of buffers?
Things like Social Security, providing income for retirees, unemployment insurance helping people who lose jobs, the SEC overseeing the markets, the widespread use of retirement accounts like IRAs, even higher rates of home ownership compared to the 1920s.
So more stability built in.
A lot more structural resilience, yeah. These things act as shock absorbers, making that kind of catastrophic, cascading failure much less probable today.
Okay, so if we boil down everything we've talked about from Peter Lynch, what's the simplest, most powerful takeaway for someone listening right now?
I think it's this. Your success as an investor depends way less on trying to predict the big picture, you know, guessing about recessions or interest rates, and far more on doing your homework on individual companies. Understand what you own through that detailed script, and crucially, fight that instinct to cut your flowers and water your weeds. Focus on the business, not the macroeconomic noise.
So here's a final thought for you to chew on. Think about your own life, your job, your hobbies, the stuff you buy or use every day. Where do you already have an edge? What industry or company do you understand maybe better than the average Wall Street analyst just because of your own experience? How can you turn that real-world knowledge into a smart, evidence-based investment script?
Recognizing that edge, that could be your biggest opportunity.
That wraps up our deep dive into Peter Lynch's timeless investment playbook. Don't forget to subscribe and hit that like button.